Hey everybody, Preston Bryn here with our weekly roundup brought to you free by our trader user group. This is for the trading week ending March 4th, 2016. What I've got on the screen here is the E-mini S&P 500 futures. You can see, and I've talked to a lot of our members, we've been really lucky, fortunate probably is a better word, fortunate because we saw the nice bullish divergence that we had here, and I was getting our members in long right in this area here. I said we'll probably run through. I said this would be our first area of resistance, and if we bounce through it, we'll have a retest. That's exactly what we did. We came up here, we came all our way down for a retest back down in this area here, and then boom, off we went. And this retest was, pretty much a given. Because this was a huge resistance point right here, and the bulls just really weren't ready to play. The bears still wanted to drive the price lower, and lower it did. We came down here like that, actually went down to 1802 from the 1804 area right here, and then that set us up for a beautiful bullish divergence trade. And we took this trade right in this area here around February the 11th. And we've been enjoying it since. Now up in this area here, we got extended a little bit. I said we would probably have a pullback, which is what we did over the next 2 days. We touched this next resistance zone, but we pull back. And then when the bulls took charge right here, I said, okay, we're going to go through and we're going to come up to this top of this resistance zone, which is where we are right now. You can see the 200 EMA. Also, we sprung above it, but we closed the day right around the 200 EMA 1995 on the E-mini S&P 500 futures, and right at 1999.99 on the SPX cash index. Now, the other thing I want you to note, we're still underwater. The 2016 open price, the 2016 high price occurred on the same day, and we're shortly below that. Also, the 50 EMA right here, this line is still below the 200 EMA, so we've got some issues. Also, I've got the price over volume, or volume over price is probably a better way to say it. And you can see these huge spikes in volume right here. So there is a lot of activity in this area here with bulls and bears. And the bulls are winning out up in this area here. There's a lot of sellers overhead right in that area there, and then there's just a little modicum amount of sellers right up in that area there, or potential buyers. But so we've got some really interesting opportunities, and we've got some inflection points that are going to be setting up over the next 2 weeks. Keep in mind, next Thursday we got Super Mario from the ECB coming out. The expectation is he's going to do more stimulus, but Mario has been known to be a talker instead of a doer. And oftentimes that's worked out well for him. He talks through what they're going to do. It drives the prices the way he wants, and then he doesn't have to do what he says he's going to do. We'll watch for that. And then on March the 16th, 2 weeks from this next week, in about 2 weeks, we've got... right now, we got the Feds and Janet Yellen. And I've been watching our government data coming out. We had the employment numbers coming out Friday. Some of the numbers were good. That was good for the bulls. Some of the numbers weren't that good for the bears. But all told, we moved up and we sold off again because the markets are realizing that we're still kind of in a good economic data results sometimes in bad price action for fear of raising the interest rates sooner rather than later. In fact, there was talk on Friday with some of the good economic data that'll push the Feds to raising their rates sooner. Now, right now, just so that you know, the Fed funds futures are not predicting a rate hike this March. Most of the market participants are not expecting a rate hike this March. In other words, in 2 weeks, but most people believe that the rate hike that wasn't projected until Q4 of 2016, possibly even some had them outline out to Q1 of 2017, now believe that the Feds have a stronger argument to do the rate hike sooner rather than later. So this inflection point that I'm talking about here, if I just clear this screen up and just show you again, we've had a great extension off the lows. Okay, we've moved up just shy of 200 points off this low on the E-mini, and we've done it fairly quickly since February the 11th. Actually, the actual low, we didn't hit the actual low. We got our trigger to go long right on this day here. But that was like 2 days off the low, and then we all got long, or at least I suggested, encouraged folks to go long. And we were watching this trade set up for at least several weeks. But anyway, once it took off, we're now extended almost 200 points to the upside. And everybody knows markets don't go up straight line. They have a pullback. So what I am now most interested in is this pullback that we should be getting. And we can expect, and we can anticipate. Now, is the pullback going to happen on Monday or Tuesday? I don't know. But I do suspect we could have a little bit of a pullback. Remember, we got option expiration coming up in a couple of weeks. On the week of Yellen, that's option expiration week. That week tends to be a slightly bullish week for equities. It's also going to be quarterly triple witching. So we got futures rolling. We got quarterlies going. And we've got the monthlies going. So we've got a lot of activity. So what seems to be setting up is a run up, a little bit of a pullback, and then we make another run into the option expiry week with Yellen. Now, Yellen can obviously change all of this by being more hawkish, and so can Super Mario. But let's say Super Mario is dovish, and let's say Yellen does what she always does, and she's dovish. Then this would be the more expected action that I would see. Again, very rarely, and even if we do have a rocket blast up, we always get a pullback, and then we go higher again. So for some of those out there, and you may be included if you're not in our group, definitely you're not included, but you may have missed it. If you missed this bounce here, or you got in a little bit late right in this area here, then I would set your stop losses, your sell stops fairly tight, because we can expect a pullback at any time. Now, how far will that pullback go? One of the things I want to do is I want to watch that pullback very closely. Notice here we got a lot of potential buyers sitting right down in this area right here. So I don't think if we get a pullback, we're going to go south of our S2 zone. This would be our second level of support. This takes us down to around 1920. You can see there's a lot of resistance there, which now becomes support over here. So this would be kind of like my go, no-go line on a daily chart. If we do break it and go down, then we're going to go for a little bit of a ride. All right, I think it'll be a scare the children moment. And then the question is, was this really a low put in, or are we going to make lower lows? Right now at this time, I don't believe that will happen. But I do want to show you back on August 24th, the price action did something similar. And let's just move over to August the 24th. You can see right here, we off of these lows, we came all the way back up to this area here. Okay, that is roughly about 2010. Okay, 2015, maybe 2015 area, and that's off of these lows here, which was, you know, around 1834 and some change. So that, again, the distance of that move right there is very similar to where we are right now. It's about 180 points roughly, and then we gave it all back up and we came all the way back down. We didn't have a double tap at the bottom here, but we moved a pretty good bit, and then we came back down again. Okay, so that's just to show you that, and it only took us about 2 weeks to get there. Week and a half, 2 weeks. Actually, 1, 2, 3, 4, 5, 6. Yeah, about 2 weeks to get there. So we can give it all up, and you typically fall faster than you go up. Okay, so if we come back to the current market environment, you can see right here that we've got to be very leery. I want to see who's in charge, the bulls or the bears. Um, and if we have a pullback like this, we're going to know very quickly, because if the bulls are in charge, they'll stop it in this area here and drive it higher. And then on that drive higher, if we take out whatever the pivot point is that we start that pullback, if we take that out, that's a nice sign. That shows that the odds of that being the low for 2016 are pretty solid. Right now, I can't make that bet, but that's what I'm going to be watching for on this pullback right here. Okay. Now, if we quickly go through some of the other charts, they're all set up exactly the same. If we look at NASDAQ, you can see again, we're underneath the 200 EMA. Solid resistance point there. We've had that bullish divergence, big move up, and we're sitting right on an upsloping trend line that goes back several years. You can see the volume over price. We've got a lot of support in this area right here, but we're still well away from the 2016 open price. Now, if you guys remember some of my weekly updates back in October, November, December, NASDAQ was leading the way. It was well above. In fact, NASDAQ hit highs back in December. We were nowhere near that in all the other indexes. And I said one of the things has to give. Either NASDAQ has to give or the other indexes have to give it up and go stronger, because we got to get these back in correlation again. Granted, one index generally leads the other, but not by the percentages that NASDAQ was doing. And obviously, NASDAQ gave it up and went from one of the best performers to one of the worst performers. Now where we're sitting right here, the scenario is the same. If we look at the Russell, also a really poor performer going into 2016, you can see right now that we're well south of the 200 EMA. We had, again, the bullish divergence, the nice run up. And again, I would be looking for a little bit of a pullback, and you can see this ton of volume right in this area here where buyers stepped in, right in that area there, which also happened to be one of my initial projection points of where we would go. And you can see just a huge amount of volume, but you can see all these sellers waiting overhead up in this area here, just a huge amount of sellers waiting up here. In between is kind of like, it's a dead zone. There's not a lot of participation. You know, you got a lot of sellers up here and a lot of buyers down here, which is why we can, we're kind of free to run a little bit. And we've run nicely in these small cap, but we just got so decimated. But I do believe as we get nearer all of these sellers that were lurking back when the market's just cratered, you're going to see a little bit of a pullback. They may be willing to jump back in again to the downside. But again, this pullback that we're going to get across all indexes, I want to look to see if 2016 lows have already been made. If they've been made, that'll increase the odds that the bulls can drive the price above the 2016 open price. We're still in the red, folks, for the year. And we're coming into the end of the first quarter, still in the red. So let's look and see where we get this pullback. Use that as a test to see who's stronger, the bulls or the bears. And of course, if we look at the Dow, same thing. You can see the Dow, you can see all my indicators, the high price, the open price, the low price for the year for 2016. Again, we're below the 200 EMA. We've cleared the 50, but we're still below the 200 EMA. You can see the buyers down here. You can see all the sellers up here, and then there's an area here of sellers also right in this resistance zone. And we're just shy of 17,000, the magical number. The 200 EMA sitting at 17,100 in the Dow futures. Again, we've had a beautiful, beautiful, strong bullish divergence. We've been long since February the 11th. With our finger on the trigger, of course, because you don't know if we're going to roll back over. We cleared some of these hurdles, which increases the amount of longs that come in. But we got long earlier, and now we're ready to look for a pullback. So our stops are a little bit tighter, and that's kind of where we're sitting right now. If we look at volatility, volatility has come off dramatically. If let's just use VIX as the gauge, you can see I've got my chart divided up into zones 1, 2, 3, and then if I kind of do it down, zone 4, and then zone 5 is kind of more of a black swan kind of area. But you can see that we started the year in January in zone 3 right here. This is the start of the year right there. That's where we open. We went through just a couple of days, but the higher end of zone 2. And then the rest of the time, just about, we spent in zone 3. And that's over 22 for the VIX. And now we've just started giving it up right in that bounce, that bullish divergence. And then boom, the VIX is all the way back down to the lower part of zone 2. Now, just so that you know, the average price for the VIX going back about 20 years is around 16 to 17. You guys that had just started trading, that got in after all the stimulus, all these World Bank or central bank stimulus, all globally, starting with the U.S. Feds, you probably remember where volatility's been in zone 1 for all this time, as low as almost 10 up to maybe 13 or 14, and we've just lived here for a long time. So you just assume that was a normalized volatility rate, and it's not. A normalized volatility rate going back that far without the central bank stimulus is around 16 or 17. But we're getting back into that normalized view here. If Europe stimulates, if Japan continues to stimulate, same with China, it has the tendency to drive the volatility lower. But keep in mind that, should we get our pullback, we're going to see volatility spike. Now, for our option traders, we use different strategies when VIX is in zone 1 versus zone 2 versus zone 3 versus zone 4. Different strategies come into play here, okay? We're more into debit spreads down in this area here, and credit spreads become a really big important theme up in this area here. And we can play bullish and bearish with both. And there are other strategies that work better in some zones than others. So it gives you a little bit of an edge in the option market. Again, if you're not a member, I'd highly encourage you to come in. We're starting the year fairly nicely. And I see nothing but really good opportunities going forward. And let's talk about some of those opportunities. If we look at the bond market, the bond market is, setting up for the same thing as equities, only just the opposite. You can see here, this looks like the equities, but on February the 11th, equities, while equities were going down, you can see bonds. We opened the year here and we've just gone straight up. We hit my target right up here. We were doing credit spreads and calls, bear call spreads up in this area here. But now since the February the 11th bounce, bonds have come off. Money's come out of the equity market. But I would not be surprised. We're bouncing off the 50 MA to see the bonds making another attempt up here. I do not believe we'll take out 2016 high. We do if we make new lows in 2016. We will. If not, I think any kind of rally will be short. And then I'll be more than willing to take shorts in the bond market here, like I will be willing to add longs in the equity market. Again, bonds are coming off just a little bit. We got to be very careful. Bonds are driven and influenced dramatically by central banks, even banks overseas, Japan and Europe, because our interest rates are very low right now, but they are still a lot higher than government treasury bonds in Europe or Japan. So the money comes to the U.S. and keeps our rates artificially low. I can promise you when Europe takes off, when the EU starts to take off, the European Union, and China starts to take off, bonds are just going to go flat ass down. It's going to be like a ticket in Disney World, that elevator ride where you just go straight down. Because not only will U.S. equity players come out of the bond market and take a little bit more risk in equities, but then so will Japan, and so will Europe as well, and that's just going to just compound this effect. So we want to watch this. There's going to be some great opportunities in the bond market to the downside. And if you can't trade bonds, of course, with our members, we'll either play TLT as one way to play it, or TBT is another way to play it. So these are just some great, interesting plays setting up. In the currency market, one thing we've been watching is the British pound. It is really getting pounded. You can see here we have a little bit of a bullish divergence. We're bouncing off the lows. At some point, the pound's going to be a very good long to take. The euro, you can see the euro is had this little pullback. We're going to go into the Draghi next week, and Draghi can have a major influence on the euro. He can drive that down dramatically if they come out and they actually do more stimulus. You can see a lot of volume is sitting in this area here with potential buyers. So let's see if that provides support. And then, of course, the U.S. dollar index. You can see right in this area here, the dollar, if I back it out a little bit just to give you a longer term view, you can see this enormous move in the U.S. dollar to the upside when we started our stimulus. You can see this huge volume over price here with a lot of buyers coming in. And our stimulus didn't start in 2014. It really came to an end. And you can see what it did right here. And now we got huge volume up in this area here. I think, like bonds, dollar longer term is going to be more susceptible to downward move than an upward move. But as long as we got other central banks stimulating their economies and it's a race to the bottom with their currencies, the dollar's going to be strong. But folks, that dance is going to stop, and you can see all this, the buying here, right here, holding it up. But once it breaks, there is not much down in this area here, and we're going to go for a ride. So the dollar is going to be another interesting play. We got to watch it. And then the other one that's kind of like this, it's a fear trade, is the Japanese yen. And you can see the yen, how it's hit 2016 highs up here. A little bit of a pullback right here. Some of you may say, hey, that looks like a bull flag. You're up like this and then boom like that. And then, one little final attempt, and then it's going to give it up and come back down as well. So I'll be looking for that in the yen. And there are a lot of ETFs that play these, and for our members, we'll be watching for this stuff. Let's look at gold. Gold has had a really great run. Look at gold, man. It is 2016. It's done nothing but go straight up. No interest rate. If the Feds come out very hawkish, the gold is going to give it up a little bit. I don't think it's going to come back down here, but you can see that we've been a rocket ship up. I do anticipate a little bit of a pullback into this area here. Pretty good little pullback down to all this volume right here. It just happens to be centered right around 1200. So I think short-term traders, I would be looking at maybe selling calls up in this area up here, because I do think we're going to get a little bit of a push here, giving us a little bit of an Elliott wave 4 from that 3, and then boom, we come back up this area here. We may not get that deep of a pullback. It may be a shallow one, but I do believe we're going to get a little bit of a pullback in gold. It depends on what Yellen and Mario Draghi say, because right now gold is not an inflation hedge. It is more of a fear hedge where money comes in as a safe bet. Okay. Once interest rates start moving up in the U.S., gold will be competing with interest rates, and gold generally loses that battle. So anyway, that's kind of where we are with gold. And of course, with silver, you guys know the silver story with us. I've been long silver way back down in this area here over for about, maybe about 8 months, just expecting silver to move up. I think it's going to come through the 2016 high price and keep going. We're going to have a little bit of a pullback like gold, but we're playing silver as well. Oil, we're also long oil futures, as well as USO. And we took a flyer on a couple of high risk trades that turned out beautiful on Friday. Made some great money in them. And you can see the bullish divergence. Away we go. We're still below the opening price, as you can see right up here at 37.60. Now everybody's saying this is just a canard. Oil is going to fall back down, and we really need a pullback to just gauge, who's really going to win this battle, the bulls or the bears. I think when you just have a line like this and a bounce, the bullish divergence, that was a no-brainer trade. right in that area there is when we went long. I took some oil futures. That was a no-brainer move right here. But now what we're going to do is we're going to get a pullback, and I want to measure the depth and the speed and the volume of that pullback to see, is this just normal profit taking, or is this sellers jumping back in and going to drive it back down to our 2016 low? Okay. That's what I'm going to be watching for. If we bounce and start to move up, then I'll probably be more inclined to put some more longs in oil. Now, in our chat room, we were watching the oil inventory, and the other sign that oil wants to be bullish is we came out with excess inventories in oil. Yet, oil went higher, and that was another clue. And the bulls are just coming into oil. So maybe they're betting that a bottom has been made. And you never really know a bottom's been made until it's been made and you're way forward in time. But all you can do is play the price action, and that's what we're doing. So we've made some really nice, interesting moves in the oil market. Okay. So I'm going to end it there. We've got a lot of other things that we got going on. A lot of good opportunities here, but again, just for those non-members out there, I highly encourage you to come in. We've had a pretty good start to the year. We've looked at a couple of other things, a couple of other indicators that support the thesis that the low's been made. But again, I need to see a little bit of a pullback and then just watch the bulls and the bears and the price action and the volume and where we go in the support levels to see, is that in fact true. If it is in fact true, then we're going to change up some of our additional strategies and add to it. But again, next week, Super Mario, are they going to stimulate or not? And then the week after, Yellen, is she dovish or is she hawkish? And let's play it as it is. So I will see all of our members Sunday night. If you're not a member, come on in and check us out. I think I have a special here on this video. Check it out. All right, everybody, have a great remainder of the weekend, and I'll see our members tomorrow night. Bye now.